Tito's Handmade Vodka is America's favorite vodka for a reason. From the first legal distillery in Texas, Tito's is 6 times distilled till it's just right. And naturally gluten-free, making it a high-quality spirit that mixes with just about anything. From the smoothest martinis to the best Bloody Marys. Tito's is known for giving back, teaming up with nonprofits to serve its communities and do good for dogs. Make your next cocktail with Tito's. Distilled and bottled by 5th Generation Inc., Austin, Texas. 40% alcohol by volume. Savor responsibly.
Yes, on the traditional weekly query and response financial informational podcast that we call Talking Real Money. Hello, everyone. Don here again. Yes, it's my favorite time of the week. Going and looking for your questions and then answering them in this Friday podcast. And we still have a pretty decent supply of questions, so I'm going all out today. I've grabbed 6 of them in chronological order and inserted them into today's program, and then, of course, answered them after inserting them. So, how do you send questions? Oh, it's easy. You go to talkingrealmoney.com. That's our website, talkingrealmoney.com, all one word. And then you go to the contact button, and then you speak your question with your microphone on your electronic device. It's just that easy. You can type it too if you want. Or you can call us on Saturdays from 3 to 5 Eastern at 855-935-TALK. But this is the way we do it on Fridays. It's the questions that you spoke in at talkingrealmoney.com. And here is the number one question. Well, in order. In order. I don't know that it's the best. It's just the first one in order of the day.
Hey, Don. This one's a quick question. Just wondering your thoughts on, for fixed income in your portfolio, to purely have it as CDs. So like form a CD ladder and just keep rolling with that. Bonds, I believe, have always been a little bit stronger than CDs, but there is that interest rate dependency of them that makes me a little worried, depending on what interest rates do in the future. Just to have less worry about that fixed income portion, would it be a wrong thing just to have CDs instead? Thanks.
No, wrong thing? No, totally not wrong. Or I would just be wrong because a big chunk of my fixed income is in a ladder of CDs. I like it because I know what's going to be there. I don't have to worry, at least for this portion. I also have BND too. So, but for this portion of my portfolio, I don't really have to think about market volatility because I'm not going to ever sell them in the secondary market. It's a psychological thing. The value of CDs, if you're buying them in the secondary, which I am, or brokered CDs, you could have some fluctuation in value, but if you don't look, then it didn't happen. You will see it. If you buy a CD ladder, day to day, they'll value those CDs based on the value in the secondary market, so we still get that volatility. However, if you hold them to maturity, it goes away. But it requires discipline to pull it off. You must always, the minute your shortest duration CD comes due, you must buy the longest duration. You can't go, I think rates are going to go up. I'm going to wait. No, can't do that. Must be disciplined, but if you're disciplined, it can certainly work for a portion of the portfolio for some of your fixed income. I think for me personally, it's been a very good thing. I've been doing it for a very long time, though. So send your questions in, talkingrealmoney.com. We still have a lot, but the more the merrier, the more I can answer on the program. So let's do another one.
Hi, this is Robbie in Herndon, Virginia. My daughter recently, within the past year, has gotten her first job, and she's been contributing 25% of her paycheck to a Roth IRA that I've been matching. So far, I've just been putting the money into VTI, but listening to you guys talk about the need for diversification, I'm wondering how much diversification should she have at her age, since she's not going to need the money for a long time. Am I overthinking it and VTI is fine, or are there other funds that you guys would recommend so that she'd have the right diversification for her age and for when she'd need the money? Thanks a lot. Appreciate all you guys do.
I think everybody should have more than just a VTI, just a U.S. total market in their portfolio. I think it's a mistake to solely focus your investments on just the U.S. Yeah, we have a home field bias, a home team bias, but the other teams play pretty well sometimes, and sometimes they actually play better than we do. We forget that important fact. Given the time that your daughter has, the fact that she does not need this money and shouldn't touch this money for, I don't know, 4 decades plus, 5, 6, I'd be a lot more aggressive. I'd be looking at something with small and value and emergings and all of those things. I'd be looking at an AVGE or a DFAW if you just want a one fund solution. I know they're a little bit more expensive, but they're a little bit more expensive because what they do is a more expensive process. They have indexes are easy. Avantis and Dimensional have these rules that they follow, plus they're also buying more lightly traded securities when they get into very small, micro-cap, emerging, all those things, and that increases the cost of doing business. But that's what I'd do for my kids. So I think that's probably the best advice I can give for yours. And just like that, we're on to our third question for this Friday Q&A podcast.
I have a few details I'd like you to hear to see if you can help guide me into next steps or some reallocation. My wife and I are both 44 years old and have an 11-year-old daughter. In the next 5 to 7 years, we are both looking to early retire or switch to careers that pay much less and would like your thoughts on withdrawal order and allocation. We spend about $115,000 a year. And currently, all of our tax-deferred and tax-free retirement is allocated in about 60% S&P 500 funds, 15% international, 15% small cap, and about 10% mid cap. We have about $1 million in traditional retirement and $370,000 in Roth. We also have about $36,000 in HSA and $75,000 in 529. Our taxable brokerage, however, is worth about $685,000 and is split between about 85% S&P 500 funds and 15% small cap. Over the next 5 to 7 years, if we want to live off that taxable brokerage at the end of that, should we start heavily working bonds into that allocation to de-risk? Should we consider a 72T? Looking for any guidance. Thanks so much.
Well, I think you, like most Americans, are way overweighted in the S&P 500. I know that's been the place to be, but that doesn't mean it will always be the place to be. You need to be more diversified. I don't know that there's really a need for mid. I might increase my small a little bit, although 15 is pretty good. But I would definitely increase my international allocation. I would take that 10 from mid and move that, and because it's in a retirement account, and move that into your international. I would also tend to want to increase your international in your taxable account with new contributions going forward. And I would keep contributing for the next 7 years so that you've got the double whammy of the portfolio growing, all of the portfolios growing, and that added wealth being poured in. Find any extra money you can. And another thing you might want to do is if you're planning to downsize your job or retire completely in 7 years, you might want to look at ways you could get that $115,000 down. Because without Social Security, based on what you have today, drawing a $115,000 income from this portfolio is not going to be an easy task. Now, given the fact that you got 7 years to grow it, well, as aggressive as you're being, there's the semi-decent possibility based on history that this could come close to doubling, particularly if you're adding money. So in that scenario, if your expenses only increase at the rate of inflation, you're going to be in great shape. And so you could do the 72T, which is the substantially equal contributions over your life expectancy, taking money out early, but you really need, I still think you need to concentrate on growing. Now, with that said, bonds are in a portfolio for one reason. That's to keep you invested. They're there to dampen the pain of a downturn. And I can pretty confidently state that sometime over that 7-year period, we will probably have a substantial double-digit downturn that could last for a while and scare the living daylights out of you. And just the fact that you have so much in the S&P 500 tells me a little bit. It tells me you're predisposed toward slightly shorter-term thinking. You still have a good long-term philosophy. But the fact that you've tended to concentrate in those things that you perceive are doing well, in other words, have done well, tells me that you might, in a 50% decline, think about that. Your portfolio goes from $2 million to $1 million. How are you going to feel? My guess is not good, because it's going to look like your dream of a 7-year new job / retirement is gone. It's going to look like that. It's going to feel like that, and it's not likely, but it's possible if the downturn happens at the end of that 7-year period, that it realistically stops you. So that's why you have bonds. So yeah, I'd probably start considering bonds too. That lowers your potential down the road from maybe getting it to 4 million to possibly getting it to 3. But even at 3, your 115 is likely to be doable. But like everything else in life, we don't have any guarantees, and you need to remain flexible. But yeah, I'd probably start, since you're thinking about a 7-year retirement horizon, I'd probably start thinking about some fixed income in the portfolio, because you don't have any. But more international, definitely more international in your portfolio. Not because I think international is going to do better, but because I know it's bailed us out in the past, and the international markets tend to be almost as good as ours over long periods of time. The developed and and emergings have sometimes done incredibly well. So I think you need that diversification. Thanks so much for the question, and we're moving on to the next one.
I've had a HSA for probably 10, 12 years now. And for the last 10 or 12 years, I've been saving all of my EOBs, all of my medical expenses, all of that stuff. And I have all that. What I don't have is the payments. So, for instance, most of the time I pay my medical bills online. And when you pay online, it asks if you want to print a receipt. And I don't, because I don't have a printer. So I've got all the EOBs, I've got all the bills, I've got all of that stuff. What I don't have is all the receipts for all the payments that I made for all the payments that I've made, because I've paid those bills out of my own money and not out of the HSA, but I don't have those receipts. So once I turn maybe 65, I plan on starting to use some of that HSA money, and I plan on, using some of those receipts and getting some of that money back. But again, I don't have them. I just have the EOBs. So my question to you is, when it comes time to start doing that, I don't know, what are the chances that I'll get audited? Will I only have to come up with the receipts if I get audited? Should I start going back 12 years now and start getting those receipts and start saving them? So just wanted to know your opinion on that. Thank you so much, Don. Bye-bye.
Okay, you're welcome. I hate taxes. I do. They're just so confusing. All right, chances you'll get audited. The minute I say this, you're going to get audited, but the chances of getting audited are so slim. I mean, in particularly now. But anyway, you are allowed, and this is not tax advice, okay? But I know that this is true. You are allowed to recreate your expenses. You don't have to keep receipts. You can go back and look at your credit card bills and go, oh, there was a medical expense. Oh, there was a medical expense, and then document them that way. So that may be something you want to go back and do, just so you feel comfortable that you have good records. But if it comes to the point where you get an audit notice, you can go back and go through your bank statements or your credit card statements and recreate those qualified expenses, and probably not have any issue, get in any trouble. don't worry about it. The other thing you might want to do going forward, and you may even be able to go back and do this if you can go online to those purchases, you don't have to print to a printer. Almost every operating system I'm aware of, Mac OS, iOS, Windows, they all have a print to PDF feature so that you hit print, create the PDF, and then store your PDF in a folder on your computer. You could have a health expense folder and just drop those PDFs in there so they're all right there for your future audit purposes. But you probably won't get audited. Thanks so much for the question. I think we have two more. If you want to send one in, go to talkingrealmoney.com on the contact form and speak it, preferably. You can type them too. Or you can also call us on Saturdays because we have conversations on our radio show. That number, 855-935-8255. But it only works from 3 p.m. to 5 p.m. Eastern Time on Saturday. Next question.
Hi, this is Keith from Texas. I've got a question about 529 plans. I've got my kids currently in a Schwab 529 plan. I know there's other ones out there and some are better than the others. How do you go about researching which one is going to be the best outlook for your kids? My kids' ages are anywhere from 2 to 12. Thanks much and enjoy the podcast.
Schwab has a fine 529 plan. It's low fee. It's got access to all their investments, so you can get the same kind of ETFs that we talk about here. You can get some target date products if you want. You can go a lot of different ways. It is a fine, fine program. Nothing in the world wrong with it. And that said, though, I still think the Utah plan is the best. It's just got so many great options. It's so well run. But you're with a great one right now as it is. So you can go online, just type into any AI and say, what are the best? And you'll see that Utah and Schwab will probably come up on that list. So you're doing really well. Just make sure you don't buy high-fee funds. Make sure you've got the proper diversification. Make sure your allocation is right for your kid's age, which means you need a glide path as you get closer to needing the money, absolutely knowing you're going to need it. Then it needs to become a more conservative portfolio. So they can do that for you with a target date type product, or you can do that yourself. But those are the important things you need to consider. But Schwab's 529 is as good as any. Now, it's our last question. That was pretty fast. Well, it felt fast.
Hello, my name is Mike. I have a question about the Dave Ramsey theory of investing. I heard you talk this week about how you had some flaws with it. We've done this consistently for years. We do a quarter international, quarter small cap, a quarter mid cap, and a quarter large cap. He uses words like aggressive growth and things that just confuse me. I go by the size of the companies, and I think that's really helped me understand the process. Now, that being said, I'm 44 in December. My wife is 44. At what age do we start investing in bonds to have some dry powder if the market drops? We're looking to retire around 56. Or do we just keep staying the course even though the market could put us at risk? And there is that emotional piece when it does drop, right? You kind of like some safety there, I would think. And then I have a second question.
Well, look at that. The second question means you guys get a bonus. It's like having 7 questions in the podcast instead of 6. Okay, well, one, you're not even following Dave's wacky advice, which Dave's wacky advice is like aggressive growth and income. You know, what he's doing is he's following the American funds way of designating funds. But you're not following that. You're actually going with cap-weighted asset classes, which is fine. There's no evidence that mid-cap belongs in there, but mid-cap is fine. I mean, it just means slightly smaller companies. So what you're doing is okay. I think it will probably just serve you well, particularly if you're using index products. So let's go to the bond question, because you're really doing kind of what we suggest. It's large cap, small cap. You don't have value. You might want to have some value, but we're looking at academic asset classes, but you're fine. The bond component. You mentioned the reason why bonds should be in the portfolio. the emotional part of us. What I would strongly suggest you do is go to talkingrealmoney.com. It doesn't cost anything. It doesn't put you on a list where you're going to get, like sold stuff. Just go to talkingrealmoney.com and take the risk quiz. It's a 10-minute Q&A that asks some very telling questions that help you understand what your risk tolerance is. And it'll actually give you a score and a possible allocation to keep you a little bit more comfortable. And as I said earlier, this episode, you have $1 million invested, the market tanks, you're down to $500,000. How do you feel? What will you do? If you'll do something bad like sell and wait for better times, then no, you got to have bonds now so that it doesn't feel as oppressive, as awful, as horrible, as destructive as it can feel when the when the internet is screaming the world is coming to an end. So you're going to want to have some bonds. That's one way to determine that. Now let's do your next question.
We did buy a rental house cash, and we're in the process of saving for a second one. And we also drive 2 cars that have a combined age of 34 years old. So we're sitting on, buy a car fund, buy a second rental property fund. We're sitting on over 6 figures in cash. I do work 3 jobs, and we're doing the hustle, we're doing the grind. Is there a better place than just a CD or a money market right now to sit on cash? In my mind, I like it safe because if you do find, if the vehicle does crap out, you have the money to replace it. And I also like if we get to 150 and there is a foreclosure or a pocket listing that has to move fast, like we had last time. We were sitting right around $130,000, $140,000. We were able to make that punch quick. We were able to react and get that property much under value. All right, thank you. Look forward to hearing from you. Bye.
Well, that's the question that is asked a lot. I mean, can I make more money somewhere else? Maybe, but you have to take more risk in doing it. So it depends. If this money is money that you do not want to see fluctuate at all, then you want to stick with a money market, high yield savings, or short-term CDs. If you don't mind a little volatility, you might be able to make a smidge more in a bond fund like BND, a smidge, not a lot. Anything that is a higher yield, no matter what people tell you, is going to have a commensurately higher risk associated with it. It just may not show itself until the time when you most need the money. And we've seen this happen over and over again through the decades. So money market, high yield savings, short-term CDs, probably your best bet for parking money. And I hope you look at real estate. It sounds like it, since it's rental property. You look at that as one of your jobs, I assume, not as a passive investment, because owning real estate, particularly rental real estate, is far from passive. It's a business. Thank you so much for all the great questions. Thank you for continuing to send them in at talkingrealmoney.com on the contact form. Please keep doing it. And if you get a chance, tell folks about the podcast, because that's the only way we really grow, is you telling others about what we're doing and that we're trying to provide a valuable service to everybody who has any money and wants to have more in the future and wants to retire comfortably. Because we may sometimes be wrong and you may disagree with us at times, but I'm telling you, our intent is always noble. We're trying to help you. Yes, we make money in the financial services business, but as you've noticed, we don't just sit here and tell you to call us, call us, call us. We want you to do this right, always, and avoid all of the bad stuff, which is why sometimes I get really angry with people. Not you, but other people. So send in your questions, talkingrealmoney.com. Call us on Saturdays, 855-935-TALK, between 3 and 5, 855-935-8255. Thank you so much for listening. And remember, we're here 5 days a week talking real money.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor.
Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services.
Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.